Welcome back, everyone. Have you ever drawn what looked like the perfect trend line, only to watch the market do the exact opposite? You're not alone. Today, we're going to fix that. I'm going to walk you step by step through drawing trend lines correctly, spotting fake breakouts, trading trend continuations with confidence, and avoiding the common traps that trip up 90% of beginners. First, here's what to expect over the next few minutes. We'll start by defining what a trend line really is and why it matters. Then we'll dive into distinguishing fake breakouts from real ones and show you a clear confirmation checklist. Next, I'll share a simple yet powerful trend continuation strategy. We'll even uncover an advanced liquidity hunting tip that most traders overlook. By the end of this session, you'll have a reliable toolkit for reading trend lines like a pro. So, if you're ready to transform your trend line skills and potentially save your portfolio, let's dive right in. What exactly is a trend line? Imagine a diagonal safety net for price action. In an uptrend, you connect the swing lows, the valleys where price dips, to mark your support line. In a downtrend, you link the swing highs, the peaks where price rallies stall, to draw your resistance line. But here's the catch. You need at least two crystal clear anchor points, two obvious tops or bottoms where price sharply reverses. Pro traders often use the wicks of candles for consistency because they represent the true extremes of price action. Now, never force a line to fit your bias. If those two anchor points don't naturally line up, it's not a valid trend line. An obvious line beats a perfect-looking but contrived line every time. Why do trend lines matter? Trend lines aren't just pretty drawings, they serve two major functions. Early warning system: when price approaches your trend line, it's decision time, bounce or break. That's when you pay attention, because big moves often happen at these junctures. Hidden opportunity detector: that random bounce you missed last week? A well-drawn trend line could have flagged it ahead of time, giving you a low-risk entry. But a quick warning: never trade off a trend line in isolation. Always combine it with other confluence factors: key horizontal support and resistance, Fibonacci retracement levels, or reliable candlestick reversal patterns. Confluence breeds confidence. Fake breakouts versus real breakouts. This is where most traders get wrecked and where fortunes can be made. Fake breakout: price barely peaks past the trend line with tiny candles that lack momentum and volume. It's a trap set by the market to shake out weak hands. If you jump in too soon, you get stuck. Real breakout: picture a freight train barreling through the trend line. Big, aggressive candles that decisively break the next swing high or low. That's momentum you can trade. How do you confirm a breakout? Here's a simple checklist. Observe candle size. Bigger is better. Look for volume spikes on the breakout candle. Wait for price to retest the broken trend line, now acting as new support or resistance, before entering. Follow those 3 steps, and you'll dodge 80% of breakout traps. Trend continuation strategy. All right, let's say the trend remains intact and price dips back to your trend line. You want to ride that trend further. Here's what you look for. Bounce at the line. Price actually touches or slightly dips below the trend line. Rejection candles, long wicks, or a clear bullish engulfing in an uptrend, or bearish engulfing in a downtrend. New high or low after the bounce: price makes a fresh swing high in an uptrend or a fresh swing low in a downtrend. Your entry signal comes on the retest of that bounce when price revisits the breakout level as confirmation. Place your stop loss just beyond the recent swing low for longs or swing high for shorts, and ride the trend until you see early signs of a reversal. Advanced tip: liquidity in trend lines. Here's a pro-level insight many retail traders miss: trend lines often hide clusters of stop orders. In an uptrend, short sellers tend to place stops just above the trend line. When price dips below, triggering those stops, you get a little liquidity collecting move before a swift reversal. Smart traders use this to their advantage by targeting those zones for high probability entries. Live examples and recap. Let's bring it all together with a quick live demonstration on the chart. Notice the tiny candles poking below the line. That's a fake breakout. Then watch as big authoritative candles push through, the real deal. Finally, see how price comes back, touches the line, and rockets higher. That's your continuation setup in action. To recap, here's your step-by-step roadmap. Draw valid trend lines with 2 clear anchors and candle wicks. Combine trend lines with confluence factors for high-confidence trades. Use our 3-point checklist to differentiate fake from real breakouts. Deploy the trend continuation strategy. Bounce, rejection, new swing. Hunt liquidity zones around trend lines for edge. If this tutorial clicked for you, do me a favor and share it with a trader friend who's been struggling. Drop a comment below with the word trend lines if you'd like a follow-up on advanced tactics, and don't forget to like and subscribe for more step-by-step trading breakdowns. Until next time, trade smart, not hard.